Hello, my name is Melissa Golding, and I'm the press officer for the Group of 30. I'd like to welcome all of you to today's live press conference and webinar launch of the G30's new research report, the Federal Reserve's Monetary Policy Framework, More to Do to Buttress Independence. We will begin the webinar with opening remarks from the chair of the G30 Working Group on the Federal Reserve Monetary Policy Framework, Mr. Bill Dudley. After Mr. Dudley provides an overview of the report and recommendations, he will lead a roundtable discussion with project working group members Mervyn and Masaaki Shirakawa. The end of the event will be designated to audience Q&A. Please note that this report and webinar presentation represent the views and recommendations of the Group of 30's Working Group on the Federal Reserve Monetary Policy Framework, and not the Group of 30 as a whole. While the report reflects broad agreement among the working group's participants, this does not imply agreement on every specific observation or nuance. The working group chair and members participated in their personal capacities, and their participation does not imply the support or agreement of their respective public or private institutions. Today's speakers are likewise participating solely in their personal capacities. I'd now like to introduce Bill Dudley, chair of the G30 Working Group on the Federal Reserve Monetary Policy Framework. Mr. Dudley?
Thank you, Melissa. It's a great pleasure for me to have the opportunity to discuss the Group of 30 report that we're releasing today. This is a follow-on to last year's report, the Federal Reserve Monetary Policy Framework Review, a comprehensive report to improve robustness. Before diving in to discuss the motivations for this report and its key recommendations, I think a few words of thanks are in order. First, I want to thank the other members of the working group, Mervyn and Masaaki Shirakawa, who are joining us today, and they'll be part of the conversation. In addition to them, Mohammed El-Arian, Jacob Frankel, Guillermo Ortiz, and Yigong also participated. The working group members provided tremendous expertise, advice, and support in the preparation of this report. And Maria Cueto of the Group of 30 that were responsible for the preparation of the report, and Raghuram Rajan, the chair of the Group of 30, which lent his support and got this report in motion. In terms of the run of the show, I'll discuss the report, then we'll have a conversation with Mervyn and Masaaki Shirakawa, and then we'll open it up for Q&A. So we undertook this report for four reasons. The first reason was that the Federal Reserve's independence is under unprecedented attack. And we wanted to underscore the dangers of the Fed's independence being eroded by the attacks of the Trump administration. The second point we wanted to make is that we thought that it's important to recognize that the support for the Fed's independence, the Federal Reserve itself plays an important role by taking steps that bolster its accountability, credibility, and trust. That can actually underpin support for continued Fed independence. Third motivation was the Fed last year conducted its 2025 Monetary Policy Framework Review, and they did make some important changes. They ditched the flexible average inflation targeting regime. That was a regime in which misses to inflation to the downside were offset by misses to inflation to the upside, but not vice versa. So now we've just gone back to a 2% average inflation target. And they dropped the objective of minimizing shortfalls from maximum sustainable employment. So those changes were part of last year's recommendations, and we're happy that they did it. But the report was incomplete. The Monetary Policy Framework Review was incomplete in some fairly substantive ways. In particular, the communication reforms that Chair Powell intimated might be forthcoming last year in May were not forthcoming. When he was asked about it at a press conference following the March FOMC meeting, he said that there was not going to be a second part of the Monetary Policy Framework Review. There was not going to be any changes in terms of the recommendations. And then the last reason why we thought this is we are obviously having a leadership change at the Federal Reserve with Kevin Warsh assuming the chairmanship of the Federal Reserve at the end of next week. Kevin Warsh is a group of 30 members, so you could sort of think of this report as a little open letter of the group of 30 to Kevin as he takes on this role. We thought it would be timely to consider what steps the Fed could take to improve its monetary policy framework, to improve its communications, and to clarify its role and relationship with respect to the U.S. Treasury. The report has 8 recommendations, but today I want to really focus on the 5 of them that I consider the most important. We'll probably get into some of the other ones in our conversation a bit later. The first key recommendation is we think that the Federal Reserve really needs to develop a comprehensive framework for quantitative easing and quantitative tightening. That's currently lacking. What's needed, we think, is a framework that defines when quantitative easing is appropriate, distinguishes between quantitative easing for market functioning reasons versus quantitative easing as a way of providing monetary policy stimulus at the zero lower bound for interest rates. Third, we think there needs to be a cost-benefit framework. QE turned out to be quite expensive. The operating losses from the last round of QE culminated to about almost $250 billion. And if you look at the mark-to-market losses on the Fed's long-term asset holdings, that peaked at over $1 trillion. So if QE is expensive, there needs to be a cost-benefit framework to motivate when you begin, when you stop, and what the benefits are relative to those costs. And fourth, we think there needs to be a well-defined exit strategy. When do you end QE? How do you transition back to the desired long-term balance sheet? And how does that occur? Now, in terms of this set of recommendations, we think this is actually quite likely to be implemented under a Warsh-led Fed. Kevin Warsh, for many years, has been quite critical of the Fed's use of quantitative easing. He's noted that this is an area where the change needs to be implemented. And so I think he's going to be very open-minded to defining this a lot more clearly. And by defining it more clearly, you'll also put some limits on what and on when and how often you'll use quantitative easing. The second recommendation is that we think that there needs to be a thorough evaluation of the costs and benefits of shrinking the size of the Fed's balance sheet. This is also a priority of the new chairman, Kevin Warsh. There's 2 issues here. One is, do you maintain the ample reserves regime or not? The ample reserves regime is when the supply of reserves is above the demand for reserves. So banks don't have to go out into the money market to buy high quality liquid assets. They can just satisfy their high quality liquid assets demand by holding bank reserves. Second, if you want to maintain the ample reserves regime, then how do you actually reduce banks' demand for reserves so you can shrink the supply proportionally? In the ample reserves regime, supply has to be above demand. So if you want to shrink the balance sheet, you have to bring down supply and demand proportionally. The trick here is to reduce the bank's demand for high quality liquid assets, but at the same time ensure that they have sufficient liquidity to be able to handle stress. There's a tension here because the 2023 banking crisis indicated that liquidity actually goes out the door faster than we anticipated, not slower. So that argues for bigger buffers rather than smaller buffers. One solution that we think would be a very practical one would be to require banks to hold more collateral at the Fed's discount window and give banks credit against that collateral pledged to the discount window against their liquidity requirements. That way, they wouldn't have to hold as many high quality liquid assets directly, but they would still have, by having access to the discount window, they would actually have a robust set of resources to handle liquidity stress. Third, really important recommendation we think is worth pursuing is publishing a staff forecast with alternative scenarios at the conclusion of each Federal Open Market Committee meeting. We think this is important because we think it would facilitate a better understanding of the Fed's economic outlook and how policymakers would likely respond if the outlook were to evolve differently than the baseline forecast. It'd also be useful because it would downgrade the importance of the summary of economic projections, which are deeply flawed. The summary of economic projections focus people on modal forecasts. They focus people on the median of a collection of modal forecasts. And in the summary of economic projections, you can't distinguish why people disagree. Do they disagree because they have different forecasts about the economic outlook, or do they have different monetary policy reactions for a given economic outlook? I think publishing the staff forecast with alternative scenarios would allow one to better understand the central bank's monetary policy reaction function. I would argue that it's particularly valuable right now when the outlook is highly uncertain. We don't know how high energy prices are going to go. We don't know how long they're going to stay high. And if you had alternate scenarios, this would allow you to understand how the Federal Reserve would likely respond if things evolve in a more favorable direction or in a more adverse direction going forward. We think that the likelihood of this happening is probably fairly low. The board staff, in particular, is very opposed to publishing the staff forecast because they feel that they'll put the staff under more political scrutiny. Also, I think the Federal Reserve banks are a little bit skeptical about having a staff forecast receive so much attention because obviously it would consolidate more power at the Board of Governors and sort of take away that power from the Federal Reserve banks. But likely or unlikely, we think it's a really good idea. The European Central Bank does this with great success. When I was talking to Christine Lagarde a couple of weeks ago at the IMF meetings, she talked a lot about the scenarios, baseline, adverse, severe, and talked about how the situation in the Middle East was affecting the ECB's view about what was the appropriate monetary policy. The fourth recommendation is to clarify the respective roles of the Federal Reserve versus the U.S. Treasury. And I think doing so would help underscore the Fed's independence with respect to its conduct of monetary policy. I think you want to clarify how the Fed's balance sheet policies interact with the Treasury's debt management decisions. I think you want to clarify the Treasury's role in facilitating adjustments in the size and composition of the Fed's balance sheet. And I think you also want to clarify the use of the Federal Reserve of foreign exchange swaps to support the dollar as the reserve's dominant reserve currency. The Federal Reserve is responsible for foreign exchange swaps, but dollar policy is in the province of the U.S. Treasury. And so I think clarifying the responsibilities there would be very, very helpful. I think this is a change that's very likely. Kevin Warsh has talked publicly about a new Treasury Fed accord. And these are some of the things that a new Fed Treasury Accord could take on board. I think the important thing about the Treasury Fed Accord is that it supports Fed independence. It clarifies the roles of the Federal Reserve and the Treasury. So if it goes in that direction, we would think that's a very good thing. Obviously, if we have a Treasury Fed Accord that undermines Fed independence, obviously the Group of 30 would not be supportive of that kind of outcome. Then the last key recommendation I think is that I think would be very useful is to have an outside review of experts of the Fed's monetary policy framework and how the Fed conducts and communicates about monetary policy. This would be an evaluation of the Fed's operational framework, the cost and benefits of the Fed's ample reserves regime, the appropriate framework for quantitative easing and quantitative tightening, and also review how the Fed communicates about monetary policy. This is something that has plenty of precedents. The Bank of England has conducted outside reviews. In fact, Kevin Warsh led an outside review of the Bank of England's communication policies in 2014. The Reserve Bank of Australia has had an outside reviews. The Riksbank just recently completed an outside review of experts. I think that, in fact, the Federal Reserve itself is doing an outside review right now of the 2023 U.S. regional banking crisis. Michelle Bowman has hired Sterling Trust Sciences to do a review of the supervisory practices. I think doing an outside review with outside experts might lower the temperature a little bit. It might depoliticize the process. And it also might help Kevin Warsh gain broader support for his own reform efforts. I think it's uncertain whether we're going to go down this course. Obviously, you have to pick the right experts. You have to be willing to listen to those experts' recommendations. And obviously, you lose a little bit of control in the process because you're not really sure where the experts are going to land in terms of their recommendations. Federal Reserve independence is really important. Independent central banks with respect to monetary policy have better outcomes in terms of inflation and employment. That's why the trend around the world has been to move to greater independence. Enacting reforms that improve the Fed's accountability and credibility could go a long way, we think, in protecting the central bank's independence. And that's really one of the fundamental motivations of the report that we're publishing today. So with that, I want to now turn to Mervyn King and Masaaki Shirakawa to join the conversation. I have a number of questions that I want to pose for them. The first one is a very general one. I'd like to hear their thoughts on the paper, the conclusions, and their thoughts on the importance of central bank independence. Mervyn?
Bill, thank you very much. I mean, you've explained clearly, the report does, the benefits of central bank independence, of ensuring that decisions on the level of interest rates are taken by people without a short-run political incentive to engineer perhaps allegedly a stronger economy. And I think history demonstrates that central banks focused on a clear mandate given to them by the political institutions as better results. But as the report says, it has to be earned. I don't think you can assume that somehow central bank independence is a God-given feature of nature. It has to be earned. And so I got three comments really on the report. The first one is the mandate. The mandate of a central bank really ought to be focused exclusively on defending the value of the currency, maintaining its value, and doing what it can to ensure overall financial stability. Most central banks have failed to achieve stable currencies over a long period of time. And we've gradually moved towards, I think, an ability to manage paper currencies. We've been quite successful in the last 30 years, the exception obviously being 2020 to 21. But what we shouldn't do, I think, is to think that central banks therefore ought to be involved in everything. And one of the consequences of the financial crisis was the idea that central banks were the only game in town. And whatever problems were facing a country, central banks were there to deal with it. And so they did QE. Whenever there was a problem, do QE. In the UK, Brexit, do QE. When there was COVID, do QE. But the monetary arguments for doing stimulus at that point were never properly spelled out. And of course, central banks have also moved into being deeply concerned with climate change, influencing the employment of different groups in society. It's become a tool for anything. It's a way of central banks to say, we're here, we're very important, whatever the nature of the problem. And that's a big mistake. And I think having a very clear and narrow mandate is more than enough work to be getting on with. And that's a very important thing to reinforce now. Second issue is communications. There are two aspects to this. Bill has described it very clearly. On forward guidance, I think this is a flawed approach. And it's flawed because to try to give guidance to markets as to where interest rates will go is actually not that helpful to financial markets, because where interest rates will actually go will depend on a combination of the central bank reaction function and a forecast for where the economy is going to go. And you need to add those two things together to infer a future path of interest rates. There is absolutely no reason why the market will necessarily have the same forecast for the economy as the central bank. What markets want to know is the reaction function. And that's all about clear communication of what the central bank thinks is happening in the economy and how it's reacting to it. So I think the report's very clear that forward guidance is something which we can now put back as a feature of central bank history. The second aspect is to do with forecasts. And here I think there is a really complicated issue. And I can see why the report says publish a staff forecast, but the most important thing in many ways is to say, what is a forecast and what information do people outside want to see? And as Bill stressed, what they want to see is a focus on the risks to the outlook. The idea of a point forecast has always been a terrible mistake. And you might expect that, since, as Alan Greenspan always pointed out, you can't make policy in a central bank without making a forecast about the future. The people making the decision, it's their forecast that really matters, not necessarily the staff forecast. So I'm all in favor of giving much more communication about the risks around some notional central projection. And it can be in terms of scenarios, but that's not the only way of doing it. And of course, no scenario, when you give people scenarios, they always say, well, which scenario will happen? And the only answer to that is none of them. It's a way of thinking about the risks and saying how you would respond in that eventuality. And I think that's what needs to be focused on. I don't think we at the Bank of England solve the problem of trying to produce one forecast for the decision-making body, the Monetary Policy Committee. But equally, I don't think it would have been helpful for us to publish the forecast to our staff, but they weren't taking the decision. And it would simply highlight differences between the two groups, which could be awkward. But I don't think there's any ideal solution here. And I think the more communication about risks, the better. And the last one on the balance sheet, as Bill said, it is very important to have a proper framework for the relationship between Treasury and central bank. Quantitative easing is very close to being involved in debt management. Those relationships have to be settled and made clear. We didn't do that really in 2008, 2009, because everyone was focused on dealing with the immediate problem. But I do think taking one's time now to sort out a proper framework, and I do think that it would make a lot of sense to find ways of ensuring that banks have to pre-position much more collateral, and I would make this part of the regulatory framework so that banks and indeed the rest of us know that the central bank is willing to provide liquidity to any bank because it's got the collateral it needs and it's all sewn up in advance. That ex ante framework. That would enable central banks to have a much smaller balance sheet and get back to something closer to where we were before the financial crisis. So I think the report does highlight all the key issues. It's very important. And I'm sure that Kevin Walsh will want to think carefully about all of these questions. He's talked about many of them when he goes to the Federal Reserve, which I hope is sooner rather than later.
Well, it looks like he's going to be confirmed next week, which is the good news. On forward guidance, I just want to add a point on forward guidance. I think forward guidance is useful in only one really place. When you're at the zero lower bound for interest rates and you're trying to find a way of providing additional policy accommodation. But when you're off the zero lower bound, there's really no need to have forward guidance. You can just adjust the federal funds rate. And I think in some ways, forward guidance can actually be counterproductive because it sort of locks you into your forecast. And then you're reluctant to move away from that forecast. And so that creates a bias to being late. In terms of the staff forecast, I think, I agree with Mervyn that staff forecast is the second best. You'd like to have the forecast of the Federal Open Market Committee. But the Federal Open Market Committee is a very, very big, cumbersome animal spread across the entire country. And, when you look at the European Central Bank, they're sort of in the same situation. And so they've essentially compromised with the staff forecast. And I think that's probably, the only thing that's practical in the U.S., just given the setup of the U.S. Central Bank. But I completely agree that of FOMC forecast would be better.
Well, but even with 9-person Monetary Policy Committee, we really struggled to produce a forecast presentation that made sense because people might have different views. They vote different ways on interest rates. But the idea of publishing 9 different forecasts would be completely crazy.
Of course.
So it's a very difficult, problematic area, certainly.
So anyway, I think the bottom line is we can do better than where we are. And there's a number of sort of choices in terms of how to, and trying to get the Fed off of being, locked down by its modal forecast that's in the S&P. That's really counterproductive to the Fed's ability to operate well. Masaaki, what are your thoughts on the paper, importance of central bank independence? Any other thoughts?
Okay, thank you, Bill, for chairing this working group. I would like to focus on central bank independence. Central bank independence is now under attack. What we are now seeing in the US happened in Japan more than a decade ago. Back then, Bank of Japan's monetary policy was fiercely criticized by politicians. Prevailing narrative was deflation or low inflation was the cause of low growth and public enemy number one, and the solution was aggressive monetary easing. Subsequently, monetary experiments started in 2013. Bank of Japan's balance sheet expanded hugely. We now know its outcome. There is no material change in growth rate as well as inflation rate until 2022, when it abruptly rose. Now, politicians from both ruling party and opposition parties are declaring that public enemy number one is inflation. But this time, they are not calling for monetary tightening. What they are advocating instead is fiscal expansion, an across-the-board reduction in the value-added tax and fiscal subsidies, justified on the grounds of alleviating the hardship caused by inflation. Politicians tended to prioritize short-run gains over anything else. This is a sober reality. Central banks need to take this as given and ask themselves why such a change occurred compared with years prior to the global financial crisis, a period that could be described as the heyday of central bank independence. I fully agree on the importance of central bank independence, but I suspect that without genuine soul searching on the part of central banks, merely arguing for independence risks sounding arrogant and is unlikely to win public support. In my view, there are two reasons for the change surrounding central bank independence. First, the era of great moderation was unusually fortunate. Since macroeconomic performance was stellar, central banks were able to claim more credit than was warranted, even though positive supply shock contributed significantly. During that period, central bank independence went largely unchallenged, though Japan was an important exception. Second, we are now facing a range of global problems that cannot be easily solved. uh, we are now facing a range of problems that cannot be easily solved. Increased negative supply shocks stemming from heightened geopolitical risks, rapid aging and population decline, widening income and wealth inequality, and the deepening social divide, including the rise of populism, to name a few. In such an environment, people tend to view the central bank as an institution that can at least deliver something positive or provide a quick fix, especially in comparison with the government. From the perspective of politicians, central banks are convenient in the sense that they allow criticism to be deflected onto someone else. By saying this, I don't mean that central banks are innocent. Central banks must remain humble. First of all, as I mentioned earlier, central bank took more credit than was warranted during the Great Moderation. In a sense, the current situation may be described as a kind of backlash against central banks having claimed too much credit. Second, and more importantly, we cannot deny that central banks' own action generated distrust and thereby weakened public support for central bank independence. A case in point is recent high inflation. In this regard, as is described in the report, the Federal Reserve 2020 monetary policy framework proved to be a serious failure. But what we must reflect on more deeply is the validity of underpinning intellectual model to be used. In my view, the peril of deflation and the constraint posed by effective lower bound on interest rate were overstated. This intellectual model was extremely powerful, and its influence was not confined to the post-COVID period. Its excessive focus on price stability and the relative neglect of financial imbalances until the mid-2020s was partly responsible for the subsequent global financial crisis. QE was effective in preventing a collapse of financial system or in restoring market functioning. but its impact on macroeconomic conditions was rather limited. On the other hand, its costs were not negligible. One of them is the Fed expanded footprint in financial market, resulting from the massive growth of its balance sheet. This has led some to question the legitimacy of granting independence to a central bank in a democratic society. So, in sum, central banks need to make genuine soul-searching exercise on monetary policy and their communication. In that spirit, this report is very good. And this report itself is designed for Federal Reserve. But given that the soft power of US is so enormous, the the how central bank, how Federal Reserve conduct its monetary policy has a greater influence on other parts of the world. So I hope that those recommendations are seriously considered by under the leadership of Jay Powell. Thank you.
Thank you, Masaaki. I certainly agree with you that the central bank's actions really do affect the support for independence. And the 2020 framework really made the Fed quite late in terms of tightening monetary policy, and probably reduced the Fed's credibility considerably. But the same mistakes were made in other central banks around the world
Yeah,
as
that's
well.
right.
And
That's right.
the Fed has sort of cited that.
Yeah,
They cited
yeah.
that to defend themselves.
Yeah, yeah. So I'm not Christian Fed, and I would rather stress the how important the prevailing intellectual model is. Yeah, yeah.
Yeah, thank you. So, Mervyn and Masaaki, I want to ask you a question. So, what lessons did you draw from your own experiences leading major central banks in terms of the issue of Fed independence and how to sort of bolster that? Because that's obviously one of the key questions. What can the central bank do itself to create more public support for its role in independent? Masaaki, you want to start?
Okay. I would like to take up the recommendation one, which calls for developing a comprehensive framework of QE and QT. Starting point is whether or not QE should be used. This critically depends on the assessment on the period of low inflation or mild deflation and the period of effective lower bound of interest rate. In my view, the Fed was overly concerned with this period, and this concern was partly based on what it perceived as a lesson from Japan's experience, as, as among others. For example, when the Fed made explicit that it was willing to allow inflation to overshoot the 2% target in the summer of 2020. Chairman Powell explained its rationale for referring to the mechanism by which deflation leads to bad outcome as an adverse dynamic, and said, quote, this adverse dynamic play out in other major economies around the world and have learned that once it's set in, it can be very difficult to overcome. We want to do what we can to prevent such a dynamic from happening here. It is very clear that Japan was implied by other major economies. But interpreting Japan's experience in such a manner was quite inaccurate, I would say. Yes, Japan's growth rate was low, but if its growth rate adjusted uh, for decline in working age population uh, was a bit its growth rate adjusted for decline in working age population was a bit higher than that of the US. Yes, productivity-wise, Japan has problem. Productive growth is declining, although this trend is not much different from that of other advanced economies. But this decline is due to various structural factors, not inflation or deflation. On the other hand, its cost or side effect of massive QE have proven to be quite high. Unwinding QE has not been easy, as reflected in the fact that the Bank of Japan's real interest rate remains so low. So, my advice to the Fed, based on Japan's experience, is that relative high bar should be set for adopting QE. And my remarks does apply to QE as a macroeconomic stabilization policy. In terms of restoring market functioning, I'm a strong supporter of QE. Thank you so much. Yeah.
Mervyn, thoughts?
So I think my experience was I was at the Bank of England when we obtained our independence. And so people could see very clearly that before independence, interest rate decisions were heavily influenced by short-term political considerations. So everyone could see the problems with not having independence. And then we introduced independence, and there was a great deal of support for it. In order to maintain that support, I think the key thing was to give as much explanation as possible about what we knew and what we didn't know, and being honest about it. Politicians seem incapable of using the phrase, I don't know. And that's actually very damaging to them in the long run. But central banks should be willing to say that because they do know quite a lot, but they don't know everything. And having a clear explanation of the risks and uncertainties involved actually builds up credibility because people think, yeah, these guys know more about what's going on in the economy than anybody else. They don't know everything. They don't claim to know everything, but they tell a very convincing story. So we're willing to trust them with the decisions to set interest rates. And I think that was, to my mind, the most important change that came. And I think where things started to go wrong was where, certainly in the case of the bank, they abandoned the refusal to focus on a central forecast, a single number, a point forecast, and tried to use single numbers because they seemed to be more effective politically. And that was a big mistake because it wasn't credible. People say, well, how do you know? Well, because you can't know. But spelling out what we do know and don't know is fundamental to acquiring trust and credibility. That, to my mind, is the big lesson that I learned and the most important one for central banks.
Yeah, we published a paper at Group of 30 a few years ago about being central banks being humble, showing humility. And I think your point about being clear about what you know and what you don't know is really important. And also, when you do make a mistake, admitting that you made a mistake and why you made a mistake, and then what are you going to do about it so that you don't make the same mistake going forward. And I think the Fed's 2025 monetary policy framework review essentially admitted the mistake of the 2020 framework.
Yeah.
And I think that was very fortunate. But there's more to do.
Yeah.
Yes.
So last area I want to ask you about. So, we have the Federal Reserve, obviously very important central bank in the world. Where do you think other central banks do it better, and in what areas? And if Kevin Warsh is going to study other central banks, who should he study, and what lessons should he take away from that evaluation?
Maybe he should read G30 reports.
Well, he has this report, so yes, hopefully he's read it.
I mean, some of the issues involved, such as the discussion we had just now about what forecast to publish, I think are specific to the institutional setup of each country. And so it's unlikely that you can gain a lot by looking elsewhere. I think actually having the reviews is a good idea because you just get someone with a fresh eye and a different background to come in and see how they react to what you do. And that, I think, is valuable, rather than going to look for a model of what to do. But I think, we've all expanded the use of press conferences. We publish more material explaining decisions. The one thing I would say is that, and this comes back to something in the report about, is there too much communication? And I think there is a danger of not being precise enough about the communication. So the example I would give is, if you make an interest rate decision, and then you have a press conference where uh, the chairman explains the decision and the reasons for it, it would be a mistake, in my view, for the chairman then to give lots of interviews over the next few days, trying to add to that, because then you inevitably get different words being used. The media pick them up, you get confusion. So basically, you should only communicate when you've got something to say. And once you've said it, stop until you've got something new to say. And that feeds into this question about the other members of the committee giving speeches and communicating. Obviously, they have a right to do so. But I do think the timing of it is important. So we tried very hard, not easy, we tried very hard to get different members of the Monetary Policy Committee not to give speeches on the same day, which they often wanted to jump in after a meeting and explain their position. Because when what you got was the media saying, oh, Mr. X thinks something and Mrs. Y thinks something quite different. And you get then focused not on the substance of the decision, but on the personality differences. And I think it is important to try to avoid that as far as possible.
Yeah, I think that the Federal Reserve has that to a limited degree in the sense that you're not allowed to give a speech until Friday. So the meeting is over on a Wednesday. The chairman gives the press conference, and then you can't speak publicly until Friday. But in the U.S., there's 19 different participants on the Federal Committee, so there are a lot of speeches. I think it does create confusion at times. But at the same time, you can argue that it does create different perspectives, and it does sort of create multiple scenarios in some sense. And so, I also would put some weight on the wisdom of crowds. And I also don't think it's as confusing as people think. I think people understand that you really want to focus on where the chairman is. Chairman has a disproportional role to play in the central bank policy making because the chairman sets the agenda. The chairman really controls the staff. And the chairman is the one who's actually trying to build a consensus on the committee. So, I do think there's probably confusion at times in the U.S. with so many different people talking. But at the same time, the fact that they get to talk probably also encourages better people to go work at the various Federal Reserve banks because they like that ability to be part of the public dialogue. Masaaki, any thoughts?
You don't want them all to jump in on the following Monday and have.
You want to have a little space.
Yes.
Yeah. I
So
agree.
it needs to be a managed process.
Masaaki, any thoughts here?
Yeah. Okay. My answer to your question is that I don't think other central bank would necessarily do better, and there is no model to be emulated. As I said earlier, political attacks on central banks partly reflect the current economic, political, and social environment in which there are no easy solutions. If that is the case, I don't expect the situation surrounding central bank or central bank independence to improve quickly. One of the difficult challenges facing central bank is how to communicate the importance of structural factors to politicians, financial market, and the citizens when various structural forces are weighing on the economy. As long as the economy is not performing well, central bank will always be in a difficult position. For instance, when I was governor, I often pointed to the importance of structural issues related to productivity and demographic changes. But the more the Bank of Japan talks, the more it was criticized. Critics said the Bank of Japan is deflecting criticism towards someone else. Your job is just to print money. The problem due to structural factors are confined not only to their communication or monetary policy, but also to its very conduct. In the United States, for example, importance of structural factors may be growing inequality and increasing social divisiveness. In Fed's monetary policy framework review in 2020, inclusiveness was overly emphasized, in my view, which became one of the reasons for subsequent high inflation. In this respect, I recall what Paul Volcker said some years before he passed away. The maintenance of independence in a democratic society ultimately depends on something beyond those institutional qualities. The Federal Reserve or any central bank should not be asked to do too much to undertake responsibilities that it cannot reasonably meet with the appropriately limited power provided. I couldn't agree more with what he said. However, I'm not sure how a society can actually achieve such a situation, since each country has its own structural problem and unique social contract. There is no single model that other countries can simply follow. Each central bank needs to make its own effort. And that's my reaction. Yeah.
Thank you, Masaaki. Thank you, Mervyn. I'm going to now turn to the Q&A portion of this call. We've got a number of questions, and I think there's sort of three broad categories I'd like to cover. First, questioner asked about the communication and coordination of the Federal Reserve with the U.S. Treasury about fiscal policy and raises the question about whether that will compromise the Fed's independence. And I think my own answer to that is it depends what we mean by communication and coordination. If the Fed is subordinating monetary policy to finance the federal deficit, obviously that's not good. That is definitely compromising Fed independence. But if the Fed is just talking to the Treasury about what the Treasury's plans are and what the administration's plans are for fiscal policy, that's very germane for what the appropriate stance is of monetary policy. And I don't think that constrains monetary policy in any way. So I think it's really important when you talk about fiscal policy versus monetary policy, what are we really talking about there in terms of coordination? Are we talking about just one side knowing what the other side is doing so they can take that into consideration in their own decision making? That certainly makes sense. But if we're talking about the Federal Reserve being forced to monetize federal debt to make it easier for the U.S. government to finance its deficit, that would be a disaster. That would be the end of Federal Reserve central bank independence. Any thoughts, Mervyn, Masaaki, on that question?
I just agree with everything you've said.
So it's okay if it's done properly, but it's not okay
Well,
if it's done
I mean,
improperly.
it's sensible to have
Second set of
private
questions.
discussions. It's sensible to have private discussions between the Treasury and
Yeah,
the
I mean, I
Fed.
think that they
And
yeah. In fact,
the
the chairman has lunch every week or so with the Secretary of Treasury, and that's been a longstanding tradition. Zaki.
yeah, the concept or meaning of a code is somewhat ambiguous. And I don't think any treasury say we ask central bank to follow our advice, and that never happened. And but when it comes to so-called fiscal dominance, it is not due to straightforward request from treasury, but rather it is based on central bank's own perception of what would happen if interest rate goes up. So the last year in the annual conference of BIS, the Carmen Reinhardt described this as fearful fight. And so, in a sense, central bank changes its monetary policy conduct for possible reaction, which a monetary policy action impose. So, what is more important is how should avoid the situation in which central bank should should do some kind of monetary policy which takes on the tone of fiscal dominance. That is my reaction.
And obviously, the best way to deal with that is to make sure that fiscal policy is on a sustainable course.
Yeah, yeah,
If fiscal policy is not on a sustainable course, that's going to increase the
yeah,
pressure on the central bank
yeah,
enormously.
yeah.
Second set of questions are about the liquidity framework, and what can be done to change the liquidity framework. And the questioner is concerned about that if you really change the liquidity regulations, could that come at the expense of credit provision, that we could have less credit available in the economy? I don't think that's really where we're headed. I think where we're headed in terms of the policy discussion on liquidity is to basically change the liquidity regulations in a way that continue to make sure that banks have adequate access to liquidity, but in a way that they don't have to hold as much high quality liquid assets directly on their balance sheet. Stephen Moran, who's the governor at the Federal Reserve Board, and a number of Fed board staffers published a paper in March where they outlined 15 different ways one could reduce the demand for reserves in the United States, but still stay within an ample reserves regime. And they concluded that if you did all 15, you could reduce the amount of uh, reserves that banks would hold by somewhere between $1 and $2 trillion. So, this is definitely doable, but it's not going to happen very quickly. If you change liquidity regulation, you have to actually decide what regulations you want to change. Then you have to go out for comment for the regulation. Then you have to get the comments back. Then you actually have to implement the new regulation. So anybody who's thinking that the changes to the liquidity framework in the U.S. are going to happen quickly and that it's going to have really near-term consequences for the balance sheet, I think they're going to be disappointed because this is really probably a 2027, 2028 story, not a 2026 story. 'Cause it's just very hard to reach consensus and then actually write the regulations and implement them. Any thoughts, Mervyn or Masaaki, on liquidity frameworks?
Yeah, well, as you know, I've written about this, and my experience was that what appears to be a high quality liquid asset one day turns out the next day not to be liquid at all. And the only true source of liquidity is actually the central bank. And if you start from that perspective, then I think it's logical to go to what I call the pawnbroker for all seasons, in which banks have to pre-position collateral with the central bank. And after the haircuts, that imposes a limit on the amount of short-term funding which banks can use. And that gives a lot of flexibility for banks with different expertise. If they're good at operating payment systems or if they're good at financing risky long-term loans, they can adjust the size of their balance sheet, the shape of their own balance sheet to suit that. And that, in my view, would be the right way to go. And I think central banks are moving towards that. The greater use of pre-position collateral is evident both in the US and in the UK. And I think ultimately we'll end up going in that direction.
Yeah, I think it's a more attractive framework because only the central bank can actually expand the aggregate amount of liquidity in the system, number one. And if people know that banks have adequate collateral pre-positioned to the central bank, that also reduces the tendency to run at the first time of trouble. Because if you know the bank can always turn that collateral into cash, there's no incentive to run in the first place. So I think it's good both on an ex ante basis, reducing the run risk, and on an ex post basis, making the regime work better.
Uh, yeah,
Masaaki.
yeah. When it comes to liquidity regulation, we tend to think that both demand for liquidity and supply of liquidity are independent. But actually, my sense is those are not independent. And liquidity provision by central bank creates its own demand for central bank by financial institution. So in that sense, they are not independent. And but this means that we have to we have to design liquidity regulation by incorporating how monetary policy is conducted. And for instance, if QE is deployed aggressively and if QE is deployed for a long time, then demand for liquidity also increases. Therefore, even though liquidity problem is abundant, liquidity is not that enough. So the process for changing liquidity regulation should be gradual. Otherwise, it creates a problem. But in the longer run, we have to think about how monetary policy should be conducted when design liquidity regulation.
Yeah, and I think you're absolutely right. There's been a ratcheting up in the demand for reserves in the United States. In fact, Gurram Rajan, the chair of the Group of
Yeah,
30, has done some work on this and basically showed that if you make reserves more plentiful, then banks decide that they want to actually hold more reserves because they do lines of credit and then they want to have the liquidity available to meet those demands for lines of credit. So that
yeah,
the two things are not independent.
yeah,
So
yeah.
I think it's a very important point. A third set of questions is again on this whole idea of the liquidity framework, and you ask the questions is could the Fed change the remuneration of bank reserves? So basically say we're going to pay you the interest on reserves up to a certain limit, and then beyond that limit, we're going to pay you a lot less, so you won't want to hold as much bank reserves. This was actually something that was raised in the Moran paper that was published in March as one option. The paper was actually a little bit skeptical of how to do this because they didn't really feel like there was a very good framework for figuring out how a tiered system would work. Where would you set the tiers? How much would the interest rate on reserves drop off as you reached a higher tier? I think my own personal view is, flat remuneration of reserves at a given rate is probably the more simple approach. Some people perceive this as subsidizing banks. I don't really think it subsidizes banks because it's important to remember for every dollar of reserves, the Federal Reserve has an asset on the other side. So the Fed has a treasury bill holding against that reserve. And so the net banks aren't really they're not getting subsidized to any material degree. But that's definitely one of the potential options to reduce the demand for bank reserves. It's just a more tricky and a difficult one. Has that been contemplated either in the UK, Mervyn, in terms of tiering reserves?
Yes, it certainly has. But interestingly, the proposal has been we don't want to reduce the size of the balance sheet. We want to reduce the payment of interest on reserves as a way of raising more money to finance government spending. And of course, if you do a lot of QE, basically you're forcing the banking system as a whole to hold a lot more liquid reserves with the central bank. So,
Deposits
they're
and more deposits.
they're being forced to hold all this. And if you say to them, we're going to force you to hold this at zero remuneration, that is effectively a tax on the banking system. Now, some people have said, well, okay, let's tax the banking system up to a point and we'll remunerate the marginal reserves. But as you said, what on earth is the marginal reserve? Where do you draw the line? And that's very hard to do. So I think the right approach is actually to find ways of reducing the size of the balance sheet, because that reduces the amount of reserves that the banks are forced to hold. If you went to having a lot more pre-positioned collateral, then you wouldn't need such a big balance sheet and the issue would be a lot smaller. But it certainly has been a political issue here in the UK.
My view is almost the same as what Marvin had just said. And there's a discussion about the scarce reserve system versus abundant reserve system. And the current conclusion is ample reserve is better. And but there's a spectrum even among ample reserve. My preference is the new system should be much closer to scarce reserve system, even though this belongs to ample reserve. That's my sense. Yeah.
Well, I think in the US, we're moving to an ample reserves regime with a smaller balance sheet. I think that's
Yeah. Yeah.
where we're headed. Well,
Yeah.
we're out of time. I want to thank Mervyn and Masaaki for participating with me in this. It's been a great pleasure working with both of them, both today and over the years. And so we're signing off. And we hope that all the people take a look at the paper. And if you have any reaction, we'd love to hear from you. So thank you very much.
Thank you very much.
Thank you.